To introduce myself, my name is Tanner Oldenburger with Reserve Advisors. I'm based here in Minneapolis. I'm our VP of engineering, so I work with our engineering team of engineers across the country. I've been doing reserve studies for about 12 years now, and I've worked with over 1,000 association board members across the country. And talking about reserve studies and capital planning is pretty much the only thing I'm qualified to speak on. So hopefully today, the information that I'm sharing here that could be helpful when you're working with your community and your fellow board members, that some of this is good ammunition and good information to pass on to your community. Just a little bit of a background about Reserve Advisors. We over 30 years old, and we are primarily the focus is reserve studies, and that's where we focus on primarily in the Midwest, South, and Northeast. But we again serve the entire country for reserve studies. So based on the poll question and a data analysis that we've done recently is we're looking at the percentage of associations that are underfunded, and how we deem underfunded would be if you need special assessments or increases in greater than inflation in the future. And this is unsurprising, but 3/4 of HOAs and close to 90% of other associations generally are in a state of catch-up, of being underfunded. What we do see, though, after working with the reserve study provider on continuing on doing reserve study, we see that percentage of underfunded start to decrease. And that's really our goal, is to help associations be financially prepared for the future and be in a less state of catch-up over time. But today, what I'm going to talk about is how do we fully fund in these times of economic uncertainty, and what is really causing a lot of volatility in the project market when we go to bid for these projects. Well, there's a number of factors that can cause volatility. We see it in a number of different areas based on your market. Right now, we're seeing insurance and mortgage risks add to the potential demand for the need to complete these capital projects in order to get approved for insurance or a mortgage. Some areas that we're seeing some labor shortages affecting the construction labor market. Hot topic right now is tariffs, and I did not think that I would be commenting and talking about tariffs, but that's been a huge focus of this year with what we see happening in the market. Inflation has been a very hot topic and something we've tried to stay close to over recent years, after post-COVID, seeing what happened in the market. Other things that cause cost volatility is betterment or code compliance. We often see this is replacing of an item, and we realize when we go to replace a component that we have to upgrade it to be up to current code. So those are things, as code changes over time, technology changes, we have to perform a betterment when we go to replace that item, and it can be an increased cost. And there are a number of different project factors. I give entire presentations on this, but things that necessarily can't be forecasted or planned for. That could be scope creep when you replace siding and you take the siding off and there's additional work to the structure that needs to be done. Seasonality, whether you're in an environment where there's a short season to be able to do these projects, that can drive up the cost for those projects. Having an emergency replacement, if you have an elevator breakdown and it's emergency and needing to get a replacement at the last minute and not planned for, that can certainly drive up the project cost. So there's a number of different factors that can cause volatility that necessarily can't be forecasted, and it's somewhat challenging to stay close to that. So talking further about some of these areas of volatility, inflation, obviously a topic we're all well versed in and heard a lot about over recent years. And just highlighting here what the different construction industries and materials have seen in recent years. We've just seen some very large increases, and we're starting to see those starting to taper off. But this has been a very volatile market that we've been in post-COVID. A lot of times when we talk about inflation, the common terminology, and everyone's going to reference Consumer Price Index, CPI. So generally, we see those CPI rates between 1% and we saw a balloon up to 6, 7%. But generally, the Fed is going to target between 2 and 3% for that CPI. But another thing we stay very close to is PPI, and that's Producer Price Index. We're watching that for construction and labor. Those are the domestic wholesale goods and services rate index. And this is a much more volatile thing to track, as I'll show on the next graph here. We've seen a very high increase over the 5-year average, but we're starting to see that slow. What that doesn't mean project costs are going to go back to pre-2020 costs. We don't anticipate that happening, but we're starting to see the increases slow than we have in recent years. So I often would show this to boards and managers in previous years, and that large spike in PPI, that blue line there, that is the wacky world we lived in post-COVID. Tracking and planning for projects was very, very difficult. The volatility in the market was quite high. We've seen that slow, and we've seen that producer price index go down in a number of different areas. That red line there has a little bit more balance to it on the CPI. But again, as we're forecasting projects over a long range and short term, looking at those in two different lenses, we want to make sure we're close to both of these forecasts. Tariffs. This is a hot topic right now as we're trying to understand what projects are being affected by domestic import tariffs. So right now, what we're seeing the highest impact would be aluminum and steel. That would be for roofing. That would be if you have metal siding, HVAC ducts, aluminum frame windows. We're seeing those costs be affected. Interior renovation projects, so imported international cabinet, flooring, tile goods, we're seeing those impacted, as well as electrical and mechanical. If those are being imported into the US, we're seeing some of those costs be affected. We're also seeing a moderate impact on wood products from Canada. That would be framing, decking, roof sheathing, those types of projects, as well as some roofing material being imported in. That could be shingles, spray foam, or the fasteners that are used on the project. So not to get too specific on the individual industries, but just to highlight some areas just to be cautionary over that are experiencing current high volatility. So I do want to shift into, with all this volatility, what is the impact? I see from over the years when this volatility happened, you could shrug at this. We can go heads in the sand and we can say, well, the market's crazy right now, and we're just going to stick where we're at and we'll reassess this in a few years. I just do want to highlight what the potential risks are for underfunding. I do have a picture of Surfside here and the terrible tragedy that we saw in Florida in a few years. And we're using that necessarily not to as a scare tactic to fund for these projects, or else your building's going to fall down. But we do want to highlight what could potentially happen if we continue to kick the can on being fully funded and taking on these major projects. So the biggest one would be deferred maintenance or repairs. If we're always trying to band-aid these problems or these issues, generally the costs are going to increase as we push these projects further out. And that's going to always be pressure on the board, on management to maintain these areas. And also it gets more and more difficult to be competitive on those more aesthetic type projects if we're always trying to play catch up on the facade, the parking areas, it's going to be difficult to spend money on the pool, amenity, gym, interior areas if we're always trying to play catch up on those main infrastructure items. As I mentioned before, scope and cost increases. Generally, pushing the project out means for a higher scope and a higher replacement cost. Not always. If we're in it a few years ago, it was definitely a time to repair and maintain wood decking and not replace it when we saw that volatility. But generally, for most of these projects, if we continue to push them out, the cost is going to increase over time and not decrease. And then coordination issues, project delays. We want to, again, try to not band-aid projects and do them in partial. We want to try to take on bigger scopes of projects if we can. Sometimes that's not feasible. if we can't finance these projects through normal reserve collections, we may have to go the alternate net route of loan financial or special assessment income, and that generally adds to the timeline as well if we're trying to fund these projects through outside needs. I put that line in there, capital project logjam. I see this often is projects or properties go through these stages at 10, 15, 20, 30 years. At 20 years, we're doing the roofing project, maybe a paving project. At 30 years, we're going to do major mechanical equipment or elevator. And when these major projects line up, that generally what we have is we keep deferring out other projects, and we have this logjam where we have not been doing capital projects in stride, and now we're starting to run into other capital projects in the next era. And what happens there is often we get this project logjam where we have so many things stacking up at once. We have to go the alternate route of funding to be able to tackle those if we continue to defer. Other risks by underfunding, as I mentioned before, real estate disclosures, property values. Buyers have become more and more educated on the status of reserves and the history of special assessments. So underfunding the reserve fund just because of volatility is really exposing you in other areas when units are trying to sell their unit. We're seeing this right now with the insurance and mortgage requirements. Freddie and Fannie there's a blacklist that's out there that we're trying to help associations avoid that state of being in a structural disrepair where Fannie and Freddie would not back mortgages for that association. So deferred can lead to that. And then also local statutory requirements. I just mentioned this here as this is a shifting landscape. We've seen a number of states shift over the last few years. Florida had an update on the requirements for reserves. And I just mentioned this as, again, if we're going to take the reaction to volatility of we're not going to react to it and we're not going to adjust. If the state comes in and changes the requirements where you're living now that maybe doesn't have a reserve requirement and they change to require one, the deviation in the course correction could be quite significant. So we want to make sure we stay as close to the line to adequate funding as possible. So if something were to happen with state legislation, then the course correction is minimal. So going through all those items, I know I just touched on a lot that causes volatility and the underfunding, and I know that can be quite overwhelming, but I want to shift here to how do we be proactive? What are our next steps to be able to handle these items and understand it? Because frankly, I don't expect management and boards to understand all of those factors that I just went through. Having a relative understanding is great, but being a global industry market analysis member is not what you signed up for when you were on the board. So really, how do you best plan and prepare your association to be in the best position? We strongly believe that reserve studies have a number of best practices that if you could stay close to understanding your exposure and follow these best practices, it can put you in the best position to succeed. So I'm going to go over a few methods here on what we deem our reserve study best practices. One of the best ones here would be keeping your capital roadmap current. I use that term quite often. It is definitely a roadmap. We are not going to provide you a reserve study and say you're going to be able to follow these directions in perpetuity and continue to follow that. But that roadmap needs to be analyzed and adjusted over time. So what are things that we focus on when we're looking at the reserve study? If you have a reserve study at forecasts out 30 years, where do we even start to understand what's impactful? There's a few things that would be project prioritization and near-term timing. So I would recommend boards are talking about the next 3 to 5 years of capital projects. What projects are coming up? What projects could be deferred or coordinated with others? Which ones cannot continue to be pushed down the road? Which ones do we need to prioritize? Your current cash status and contribution levels, oftentimes you have a reserve study and you may not follow that exactly, or you have some deviation on the projects or the funding for those projects. So just staying close to understand how far have we strayed away from adequate funding or a recommendation where adequate funding is. And then our recommendation is to stay with updates every 2 to 4 years. In between that, you can do what we call as non-site updates to make sure that your financial analysis is updated. But doing a reevaluation of your reserve analysis on a 2 to 4 year basis really helps you from straying too far away for where we want to be financially. Proper preventive maintenance practices. We want to make sure that we're maintaining these items and not just waiting for them to break or fall apart. So oftentimes I do see this where associations stay very close to maintaining and how their equipment and their main components are operating. And when they stay close to this, generally that means on a more economic basis where we can get the most out of our components and useful life rather than move things up in the schedule. If there are questions about how these things are being operating or how they're holding up and conducting professional condition assessments of these items is very, very invaluable, again, for you to stay informed and close to these projects. Other best practices is making sure you're using a trusted reserve study partner that has local historical bid database that we want to make sure that the costs included for your study are specific for your community needs. So you want to make sure that there's relevant information that's backing the assumptions in your study. There's also nationwide cost databases that can be referenced. And again, staying close and having understanding what's happening in the market is also very important. And then utilizing a reserve consultant, the benefits that they offer for consulting needs. Again, I mentioned before, there's no expectation that boards or managers can be completely fluid in understanding the intricacies of the market that happen with construction and labor and materials. But making sure that you stay in line with your reserve study provider on what your goals are and what you'd like to accomplish is very, very important. If they provide you a plan that's not feasible or is not accomplishable, making sure that you're working with them to understand that you're on the same page on a strategy moving forward. Also, making sure that you're utilizing unbiased guidance. That's another important item there, is to make sure that to understand that a reserve study provider should not have an agenda. They should not be trying to accelerate projects or increase project costs because there should be no benefit there. That there should be an unbiased nature there when we're providing the reserve study, that the board can actually use that and understand that there's no agenda behind the schedule and the forecast. And ultimately, we just want to avoid surprises, deviations too far off the map from adequate funding, and staying close to this. Working with your provider, oftentimes I get those questions in between reserve studies, is we had this happen. Are we in a good state, or should we update now, or should we update in a few years? Again, reaching out to your reserve study provider to make sure, is this a consequential issue or is this inconsequential in terms of how it's affecting our cash flow? So to just tie a knot on, who benefits for adequate reserves, I do often hear on, well, it's a difficult thing to continue to raise dues. We're just going to offset things in the future with special assessments. There's a number of different ways we're going to try to explain to market back to homeowners and boards on what the benefits are of backing your assets and depreciation. So for homeowners, for maintaining a healthy reserve fund, we want to protect the investment and we want to maintain that property into the future. So they're not trying to sell their unit with a massive special assessment hanging over their heads. We ultimately want to reduce the maintenance costs and the exposure to them in the future. For the board, this is their fiduciary duty. It's not necessarily to lower down the reserve contribution as low as possible and to nickel and dime or defer projects. It's to maintain the safety and the integrity of the community. So that's the main function there. I know I have a number of items there, but the board really is to help them make decisions with an unbiased opinion to help with that. And then for managers really do prefer working with communities with more healthy and adequate reserves. So we want to avoid those surprises and we want to take those projects on in stride rather than continue to kick them down the road.